Welcome to Talk Tickers. We're the show that digs into the latest earnings calls to find out what's really driving the stock. Today, we're putting America's Car-Mart, ticker CRMT, under the microscope. You know how it goes. An earnings report comes out, the stock goes a little haywire, and everyone's trying to figure out what it all means. So how do you cut through the noise? Well, we're going to show you exactly how, using America's Car-Mart's recent quarter as our case study. All right, first things first, let's look at the headline numbers. And right off the bat, things are interesting. We're seeing a really conflicting story here. It's like a tale of two completely different tapes playing at the same time. So on one hand, you've got some numbers that are, well, frankly, flashing some warning signs. Total revenue dipped almost 2% to $341 million. And maybe more telling, the actual number of cars they sold dropped by nearly 6%. That hurts. But look at the gross margin. It ticked up by 60 basis points. That means they're actually making more profit on each car they do sell. And this is where that puzzle really comes into focus. The bad news column is pretty clear. Fewer sales, operating costs jumped over 10%, and a slight rise in late payments. But then you look at the good news column, and it's just as strong. Better margins, more interest income, and this is a big one, credit applications are up 10%. So demand seems to be there, and profitability is improving, but sales are down. What is going on here? Okay, to figure this out, we have to look outside the company's four walls, because this isn't happening in a vacuum. Car-Mart is sailing directly into some pretty significant macroeconomic headwinds. Think of it like trying to swim upstream. It doesn't matter how great of a swimmer you are, that current is going to slow you down. These are big external forces that the company has to fight against every single day. And boy, is Car-Mart facing a big one. Headwind number one, tariffs. This quarter, it suddenly cost them an extra $500 just to get a single car onto their lot. When your whole business is buying and selling cars, a sudden jump like that hits the bottom line fast. But this next headwind, this one is the real showstopper. It's a massive capital constraint. Right now, their credit line only lets them borrow 30 cents for every dollar of inventory they have. That puts a hard ceiling on how many cars they can even buy in the first place, no matter how many customers are knocking on their door. So you've got these huge forces pushing against them. What's the game plan? Are they just going to sit there and take it? Nope. This is where we need to look at their internal strategy, and it is all about technology. They're trying to build a smarter, more resilient business from the inside out. Their whole playbook right now boils down to two key tech initiatives. They're not just waiting for the storm to pass. They are actively upgrading their ship with a new loan system and a modern payment platform to make every sale more profitable and efficient. This thing, LOSV2, is the new brains of the operation. It's a brand new in-house loan origination system. Instead of just being a yes or no machine, it uses their own special scorecard to more accurately price risk. This lets them build better, more profitable loans, especially with higher quality borrowers. And the proof is in the pudding, right? Look at this. They are actively and deliberately changing who their customer is. They grew loans to their most creditworthy customers by 15%, while at the same time, they slashed lending to their riskiest group by almost half. This is a conscious choice. They're going for quality over quantity. And you don't have to take my word for it. The CEO, Doug Campbell, said it himself on the call. Paraphrasing a bit, he basically said, hey, this thing is working exactly how we designed it to, improving the health of their entire loan book. So that brings us to the big finale. We've seen the storm raging outside and the impressive upgrades happening inside. Now it's time to weigh it all, put on our analyst hat, and make the call. This really is the classic showdown, isn't it? You've got these huge external problems slamming the brakes on growth. But at the same time, you've got these really smart internal moves making the business itself fundamentally healthier. So which force wins out right now? Well, if you're a bull on this stock, you're looking at that surging demand. Application growth shot up over 26% in July. You're seeing these tech upgrades and saying, look, they're building a much stronger, more profitable company for the long run. But if you're a bear, you're pointing directly at that financing constraint and saying that is a brick wall. None of the other stuff matters if you can't get the capital to buy the cars to sell. So where do we land? For us, it's a market perform rating. And here's why. Those tech-driven improvements, they are real and they are super impressive. But that capital constraint is just too big of a bottleneck to ignore. It's a hard cap on their growth. And until it's fixed, it's going to be tough for the stock to outperform the market. And that sets up the one single question you need to be watching for next quarter. Will this new, higher quality, more efficient business model be enough to convince lenders to finally open up their wallets and give them the financing they desperately need to grow? That is the story to watch. Okay, and before we wrap, the usual but very important reminder, this is all just for informational purposes. It is absolutely not financial advice. You've got to do your own research before making any investment decisions.